All right, so guys, let me raise these questions and talk about the suggested answers, and I think this will give you a light idea of the caliber or the complexity of what I'm going to be looking for. Again, my goal, keep it really straightforward. All right, what is IRD? Hopefully, and again, guys, if you're missing something, don't be bashful. Stop me. Okay? It's income earned prior to death but not recognized before death because of the decedent's method of accounting, which is typically cash. They never receive the cash. It includes things like unpaid wages, dividends, declared but not paid, interest earned but not paid, and unpaid installment obligations. Obviously, this is just a short list. It's not the entire list. What basis adjustment is made for IRD items at the transferor's death? Here's the secret. There's the peanut butter and jelly. None. Why? 1014 does not apply. 1014 applied again. Tonight would have been a very short night. Question C, 1C. Is an IRD item included in either the gross estate of the transferor and the income tax return of the transferee, or both? Most of the time, it's both. Okay. Sometimes, it's not always both. Sometimes, remember, if the bonus was almost certain to be received, it's going to be IRD, but if it's received after the person's death, it's not considered part of their gross estate for the purposes of the estate tax. So it doesn't mean, all items of IRD are not includable in the decedent's estate. Question 1D. If an item of IRD that is included in the transfer's estate tax return, what adjustment is permitted to the person that receives it in income? And this is where you have to be careful. Again, I'm going to claim, even though Adrian, we didn't have much luck finding it, that commonly accountants, attorneys, and the like miss the 691C deduction. Okay? 691C deduction. Which of the following are items of IRD, right? This is the thrust of tonight. Identification. If you can identify it, you're good. If you can't identify it, not so good. Just like the grantor trust rules, right? Cash by the taxpayer is employed by Corporation X. He's paid once a month on the 15th. Oops, he died August 3rd, 2013. His accrual payroll is $3,000. Is that IRD? Yes, right? Quintessential example of IRD. Accrued but unpaid income. Question B. Same as A, except that A holds an installment obligation that he receives when he sold property to B. The note has a gross profit ratio of 80%, and there is a 20%, or excuse me, and there's $20,000 in payments remaining, meaning 80% of $20,000 means there's $16,000 that's going to be taxable. That's the profit ratio. That's what determines what is taxable. So question B, the stolen obligation is an IRD item. Question 2C. Same as A, except that X awards A's widow a bonus for A's long years of service. What's your question? Now it says, the answers say this is IRD because it's awarded for past services. This is including the gross estate because the decedent did not, it is not, excuse me. Okay? Now, an argument could be made if this was not substantially certain. I would omit the answer here and say, you know what? This might not be an item of IRD. Might not be an item of IRD if it was purely made in the nature of a gift. So this could go either way. 2D, or not to D. Same as C, funny joke, haha. Same as C, except A's contract provided for a $10,000 bonus if A dies before his contract expired on December 31st, 2014. Okay. So he dies. Is this IRD? And this certainly is IRD, right? There's no issue. There's beyond substantial certainty. It's due and owing. So now it would be IRD. It would be includable in the person's estate. Question 2E. When A died, he had a vested amount of $100,000 from X's non-contributory qualified pension plan. Okay? This is a non-contributing pension plan, meaning A has never been taxed on this. Should he be taxed? Well, this is easy. This is all IRD, right, guys? If this isn't, nothing is, right? So this is, again, quintessential example. 2F. When A dies, he also has a non-deductible IRA account. A has made contributions of $40,000, right? That represents his basis. So hopefully you should correct the answer to F. It should be $20,000 is IRD, not $40,000, right? It's typo there, right? It's the amount that has not been taxed yet. G. How does that A held IBM stock? A dividend of $2 per share was declared on July 20th, 2013. Holders of record August 1st, 2013. Payable August 15th. So he dies between the two. It was declared of record on August 1st, but he died in between. So that is IRD. Although not paid when A dies, it has already been declared, and therefore it has progressed to the point where it could be considered IRD because the record date has passed. H. At his death, A received 1/3 of an interest, and this gets a little bit more complicated about a partnership interest. Just for your records, question H, don't worry about. And question I, don't worry about. Again, we're not going to worry about partnerships and S corporations. My friend, when he insisted we keep this, I have very good relationships with my mother-in-law, but he apparently does not. My friend Charles Falk. A wrote a book, My Mother-in-Law, or How Whales Migrate. He receives a payment of $1 per book sold. Does it make any difference if the receipts were from a sale or merely a license? Right? And when it comes to royalties, if a royalty is unpaid, the royalties are IRD, right? They're earned, but not yet paid, right? They are IRD. If it's an installment sale, and again, we're going to be back to the future installment payments are going to be IRD. One way or another, it's going to be IRD. Question K. A owned an apartment building. Prior to his death, A signed a contract that would have resulted in a gain of $1 million. The contract at the closing of September 1st, 2013, and is subject to a contingency that the buyer was able to obtain approval for condominiums. Signed a contract that would have resulted in a gain. It was subject to contingency. The buyer be able to obtain approval for condominiums. Is that material? Is that a significant contingency?
Yes.
Yes. And that being the case, it would not be IRD. And this is very important. Okay? Let's pause for a moment. I'll repeat. Very important. Substantial contingency is not completely considered an item of IRD. In contrast, look at the next question. Same as K, except only contingencies were normal good title considerations. Those are really considered ministerial in nature, right, guys? As such, it would be IRD. Everyone see the distinction? I think everyone here could have a gut reaction. What is material? What is non-material, right?
Just to go back one to the book selling, it's only if it's a royalty contract, it's only if he earned it and hadn't been paid yet, right?
Right, it's only if he entered into the agreement, he's due and owing the royalty payments, right? They're based on his, earning it, but they have not been paid.
So not for books sold after his death?
That should not.
Okay.
Now that right has inured to someone else.
Right, so versus the installment sale, which are all, okay, got it.
Okay?
Mm-hmm.
Question 3. A sold his principal residence 4 months before his death. His executor include the income under Code Section 121. And if you guys had a chance, some of you may or may not had a chance, you do step into the decedent's shoes, right? The character of the income is the same. And if the decedent would have been entitled to Code Section 121, right, you would be, the recipient can avail themselves of Code Section 121. Now notice, if there's no sales agreement here, work to the taxpayer's benefit. Let me make the observation that when I say it doesn't, it doesn't. What happens if the person hadn't entered into the contract? Could they, let me rephrase that. If the deal had been completed, no, let me rephrase that. If the person never entered into the contract, right, 121 would not be, and now the estate owned the property, right? Someone dies owning a house, and it's now owned by the estate, right, because the person died. Jenny, was that good or bad?
Good.
Why?
Stop up.
Okay, 1014 did apply. So I know some of you are thinking, damn it, they missed their opportunity at Code Section 121. Doesn't matter. They got even better, right? 1014 applied. And just don't miss that, because I know some people might think, reading this, oh great, they got 121. It would have been better if they never entered into the contract, agreed? Because then 1014 would have raised the entire gain. If the embedded gain were 500,000, 700,000, $1 million, poof, that would have all disappeared. Question 4. A owns an installment obligation for the sale of real property to B. He's owning an installment obligation. Right? Again, it sold property to real property to B. The balance of the debt at the time of his death was $850,000. And again, 80% gross profit margin. Describe the consequences of each of the following. Is this obligation includable in A's estate? In other words, this is part of his taxable estate, this right to receive the $50,000. Sure, why not? Right, a gross estate, even though you're not responsible for this, I'm just going to. Code Section 2033 is very broad in nature. It says essentially any wealth that you have in your name when you die is potentially has estate tax exposure. Agreed? Agreed. And certainly if you have an installment note, right, it's going to be part of your taxable estate. Question 4B. The estate receives a payment of $1,100, which is $1,000 principal and $100 worth of interest. Okay? Remember, the gross profit ratio here is 80%, so $800 would be IRD, and the $100 worth of interest, right, is going to be treated. I'm going to say that's not going to be IRD, assuming the interest was earned subsequent to A's debt, the taxpayer's debt. The installment note was earned during the guy's decedent's life, right? It was just put off, deferred, because of the installment benefit. The interest that was earned subsequent to his death, the $100, is not IRD. Question 4C. A's will directs that the obligation pass to his residuary estate. Okay. A's wife receives the residuary estate. And in this case, in that particular case, this, we talked about the disposition of an item of IRD, usually accelerates the gain. This would not be considered an acceleration event. Okay? Do not worry about question 4E. We did not talk about self-canceling notes. You will not see that on the exam. Don't worry about self-canceling installment notes. Question 5. Individual A was the sole proprietor of a dental office. At his death, A owed $1,000 of accrued interest on a loan, the proceeds of which he had used in his dental office. His estate eventually paid the interest in the loan. What are the consequences? Okay. This is, hopefully everyone here can identify this. What is this? A deduction with respect to the decedent, right? The monies were due and owing. Had the taxpayer been an accrual method taxpayer, would have been able to deduct it on his final tax return up to the day it was, the interest that was due and owing. It's a cash method taxpayer, couldn't avail himself of the deduction, but the estate can. Agreed? Question 5B. Same as A, except the loan was regarding A's principal residence. Had A paid it, the interest would have been deductible, right? Under Code Section 163H, that permits deduction for home interest deductions, right? Even though it's personal in nature, there's an exception that pertains to home interest. And would this have been an item of deduction with respect to decedent? Sure, right? Okay. Question 6. This is obviously going to pertain to our 691C deduction, Code Section 691C. A has the following items of IRD and other relevant information in his estate. So we have income, IRD, total $16,000. Deductions total 6. Deductions with respect to the decedent. The estate tax is $40,000. If the $10,000, remember, we're going to combine the income with respect to decedent with the deduction with respect to decedent, right? For purposes of, so essentially, without, you compute the estate tax without, notice net IRD items. And the difference there, the estate tax had the net amount not been included, would have been, the burden would have been $36,000. And now we're going to receive this year, not all the IRD money, $4,000, which could happen, right? Because, let me just make an observation. What happens when many people receive IRAs? And Anthony, I think you alluded to this before. What do they do with respect to IRAs?
They stretch it out over the life expectancy.
Yeah, they stretch it out, okay? Code Section 401A9 permits them to stretch it out over what's called the universal table, right, Anthony? Over their lifetime. So they could take this money, the IRA money, and maybe stretch it out over, if they have $400,000 of IRA, they could stretch it out, I'm oversimplifying it, over 20 years, or $20,000 per year. So that IRD money may come in very much piecemeal. Agreed, David? It's not going to be all in one shot. And what they're going to have to do is figure out the deduction up front. When I see, figure out the aggregate. What's the overall deduction? Figure it out. And, again, you're going to look at the estate tax with the IRD money included, look at the estate tax with the IRD money excluded, figure out the estate tax relating to the IRD money, right? What's the estate, what would have been the estate tax on the IRD?
$4,000.
Okay, $4,000, right? Everyone agree the IRD money triggered an additional $4,000. So when you start getting, and if you look at these suggested answers, you got a, not complicated formula, right? You take the IRD money you receive this year over the entirety of the IRD money, you times it by your 691C deduction, and voila, your 691C deduction this year would be $1,000. And if you have multiple beneficiaries to that IRD money, where one beneficiary is receiving 1/4, the other beneficiary is receiving 3/4, how is that going to be divvied up?
Proportionally.
Proportionally, right? Everyone agree? Everyone see this? Because this is the kind of thing, I don't mean this badly, I think people know, I don't mind saying what you might see on your final exam, because that, just make sure you know how to do simple computations like this. Because this, again, I don't know if the estate tax is going to stay intact, but this is a common issue that besets accountants all the time. Accountants and attorneys, I would argue, again, if you look at the Wall Street Journal or more sophisticated tax preparation, and I even think in TurboTax, if you Google TurboTax and commonly which they try to be a little bit more sophisticated, Adrian, I really do think they try to be, they list as the top missed deductions, the 691C deduction. And maybe I'm being a little bit out of time here, because in yesteryear, when the estate tax applied to a much broader swath of the population, the estate tax historically did not apply to 0.1%. Historically, the estate tax applied anywhere from 2 to 4% generally of the US population. So that has gone down, if you do the arithmetic, guys, 20 to 40-fold. So maybe it's no longer hitting the top 10 list because there's so few people entitled to this 691C deduction, truth be told. All right, 691D deals with joint and survivor annuities. You will not see any questions, I promise you, on the final exam pertaining to joint and survivor annuities, okay? Again, I know there's disappointment out there, but bear with me. That gets into a whole nother realm that, of issues pertaining to annuities. So, let's just summarize where we are and what you're going to be responsible for next week, guys. It is a cumulative exam. It's going to be more heavily weighted to the material that we covered the second half. But the basic fundamentals that we covered in the first half, I expect everyone to have a general handle on subchapter J. I would like people to know in general, the material that we covered this class and the prior class. Can you identify, the 4 different kinds of charitable trusts? Can you identify what is IRD, what is 691B, what is 691C? If you can do that, you will do well, I am sure, on this exam. For those who came in a bit late, I will be around the entirety of this week, so if you do have follow-up questions, don't be bashful, let me know. Again, for those who came in late, if you haven't already, I think, guys, only one person has, at least when, I do not see the student surveys until January. The only thing I do see is that they will send me something to say how many students out of your entire class completed the student evaluation. So you have 2 minutes again to fill out that survey. And I think once you fill it out, I could be wrong, but I think the one thing that you will get is no further emails, okay? So sometimes that's worth its weight in gold. Anyway, speaking for myself, I had a lot of fun teaching this. I hope you had a good time being here Wednesday nights. Thank you for helping me on my paper indirectly.